in studio for Marketplace. My name is Eric Haubert, and that man right there is David Wright of Wright Financial. Thank you so much for being here, Dave.
It is always a pleasure.
All right, David, you've taught me many things on this segment. I've learned, I've written them down. They're in here, and I know that if I want to make money with my investments, I have to use GICA. Is that correct?
That's correct. There's a formula. Growth equals income plus capital appreciation. Growth meaning how much do you make on your investment, right? But that can be boiled down to two things. Income, which is actually income that's real to you, that comes in every month, plus CA. CA stands for capital appreciation, which is actually growth, which is something that you realize, Eric, if you sell the investment, right? Because capital appreciation, if it grows, you have to sell it to realize it. Otherwise, next year it could do what? It could absolutely go down.
Yeah. Okay, so I don't know a lot about math, but
Right.
but I know 4%. Is that decent? What is 4%?
Most advisors tell their clients that they can withdraw 4% from their investment and never worry about running out of money. The market will always kind of make that back. But what if you test that 4% rule over, let's say, a 20-year period from 2000 to 2020? The market average, the S&P 500, which is kind of the broadest measure, averaged 6.05%. Now, a lot of people would think it's higher than that, but it's 6.05. So if you're only withdrawing 4, you might say, I'm in good shape. 4%, 6.05, no problem with that. The problem is the sequence of returns. When you look at the last 20 years and you see drops between 2000 and 2003, and then again in 2008 to 2009, both of those drops were more than 50%. If you're withdrawing 4% during those times, at the end of the 12th year, going into your 13th year, if you had a $1 million balance withdrawing that 4% rule that all these growth advisors recommend, your portfolio has dropped to around $512,000.
Wow.
Pretty shocking. Having half your investment after 12 years is not a good thing.
Not at all. Thankfully, though, we have people like David Wright, Wright Financial, to give us the right answers. Thank you, David.
Thanks, Eric.
Inside the 13 ABC Marketplace, I'm Eric Haubert.